What's up, everybody? Welcome back to my channel. Today, I'm joined by my good friend, Matthias. We have a really interesting topic today, which is going to be merger and acquisition for e-commerce, especially exits. Matthias has great extensive knowledge for that because he had 3 exits himself. He has a background in banking. Now he's working in e-commerce and with agencies, and he has been done over 50 exits so far, right? And today we are going to talk about this whole topic of different ways of exiting your e-commerce brand. And yeah, I'm really excited. He brought some nice case studies that we're going to dive into. Yeah, so the stage is yours, bro.
Yeah, Carl, thank you so much for having me. Really much looking forward going through this topic. I think it's really, really interesting and relevant. I'm talking to so many e-com founders and brand owners who are willing to sell their brand, and they have no idea how to do that. They do not even consider selling their brand because they have never had it really on their horizon, never really had it on their plate. And if they are really thinking about exiting their own brand from a level from 5 million annual revenue, they are in a real sweet spot where they can realize probably a low 7-figure exit. And those liquidity events are so relevant for founders who are able to build great brands, because with the liquidity, they can leverage they already gained skill set. So I think it will be a great chance to dive into the presentation I've prepared for today. I called it Ecom Meets M&A. For those who have never heard the abbreviation, M&A stands for mergers and acquisitions, which means just fusions and exits, more or less. And we have 3 brands we're focusing on. All of them are German brands. The first one is Bears with Benefits. The second one is Sushi Bikes. And the last one is Snox. I think the most famous is probably Snox, because one of the co-founders, Johannes Klisch, is very, very famous and influential on LinkedIn. But there is also a great brand covered by a very famous personality in Germany who is called Joko Winterscheid. And I think a very sweet story is Bears with Benefits, not because they're selling gummy bears for a really, really high ticket, but the founding story and the entire timetable of Bears with Benefits is so short, and they realized also a 7-figure exit. So that is today's, I think we are going to 8 different topics. And the first one is how to build an e-com business that is really ready for exiting, because I think there are some founders who want to realize they exit, but they are not even able to do it. Then you have to understand what investors are really looking for in e-com, because e-com, in my opinion, is a totally new asset class in 2023. In the past, e-com has been a very niche and unprofessional part of the business world, but right now it's getting more and more professionalized by people like you, Carl, because you're getting in and you are optimizing strategies and structures, and you are treating e-com like a real business and not just like a hobby. So the next step is going to be how to find investors for e-com, because you have to look for a certain personality of investor who is really understanding what you're doing with your business. The different kinds of exiting, I called it different types of e-com exit, but basically it's all the same, different kinds of exits. And then the 3 case studies I've already mentioned. And last but not least, we're going to into some best practices for e-com, because I think it will be really helpful for your community, especially to get a handful of information to optimize their own structure regarding potential M&A transactions. So how to build an e-com business that is ready for exiting or for the exit. We're going from A to H, and the first one is clear and transparent structures and processes. By working with you, Carl, I've experienced a very extensive focus on building really, really clear structures and processes that are replicatable. Because if you have a structure and you have a process, you have to be able to replicate the process that is going on, that is not going over your table. So that is also the next step. Maximum possible independence from individuals. If you are the founder and you are working 14 hours a day, just focused on making your business work, that business is not really able for an exit. At least not for a good exit. You can sell the brand, to another brand owner who is willing to run your brand, but that is not what we are looking for in creating a good exit. You have to have a really experienced management team. And what we are talking about when we are talking about a management team is a brand which does this 8-figure plus annual revenue, because lower than that, I think you do not really need the management team, but lower than that, it's not really cost efficient. And the management team basically consists of all the C-level positions. You need a CEO, a COO, a CFO, a CMO, and you have to keep your expertise inside. Please do not work with agencies, especially not with agencies who are only focused on selling your retainer. Like Carl, probably you're working as a growth consultant, you're offering different kinds of collaboration to your partners. And by working with them in a different way, you are not really external, but you are internal, just in a different kind of structure. So another very important point is you need well-defined target group and a very clear brand positioning. If you haven't defined your target group as clear as possible, and you have not a razor-sharp positioning, your brand is going to be diminished by weeks or months, because there are other competitors who are at least comparable to you. And if you are comparable, you are losing value. What we do not want to have is a brand that is getting commoditized. A commodity is defined by being replaced of another piece that is pretty much similar. And we want something that is very unique, or you have to create something that is very unique. The next part is you have to look for a relevant market size and growth potential. In traditional business, we are always talking about TAM, which is the total addressable market. And if your TAM is too small, your business is just not worth the same as if you had the same business in a market that is double or quadruple the size. And you have to think about which market you're targeting, especially if we are in your first e-com business, you're just figuring out how everything works. It's totally fine to not go into the biggest market. But if you are trying to build a business with 20, 30, 40, 50, probably 100 million annual turnover or revenue, you have to really focus on your total addressable market, because at the tip, customer acquisition is getting so expensive that your profits are getting diminished and your valuation is getting diminished. Think about that, please. Then you have to focus on a very high quality of turnover or revenue. There are two abbreviations, OTP versus MYARR, which is one-time purchase versus multiple year annual recurring revenue. Depends on your business model. E-commerce is not just selling a product to a customer. You have to define who is your customer and what is the entire value proposition of what you are doing. So the next step is maximum possible independence from economic fluctuations. Look for something that is always relevant for people. It's like, I make a very bad example, toilet paper. It doesn't matter how bad the economy is. Toilet paper is always necessary. Just try to consider the relevance of your product in regards of the daily business or the daily life of your customer. And the last step is you have to have a well-developed exit strategy. Please think about the tax structure, the legal structure. What kind of deal are you going to realize, or what are you focusing on? Is it an asset deal or is it a share deal? If you are trying to realize a share deal with a Dubai-based free zone company, that is going to be really difficult and really expensive. Probably it is a better idea to have a German or Austrian or Switzerland company, or probably a UK limited. It's also possible. But that are all aspects you have to consider in the first place. So
really quickly, what I really like about this, and this is also what I learned from you, is right now, my mindset of how I approach the business is I'm building the business so I could be able to exit it, even if I don't want to. Just because with all of the aspects that you mentioned, the the true entrepreneurship is building the business and putting the value into the systems and the processes and not have it in your brain, right? This is the difference.
Absolutely.
Dubai dropshipper who is like doing everything himself and scaling the campaigns and stuff, to like a real brand owner who builds all of the systems and processes and then has people to do the work from. And that's what I really liked about you just mentioning these different points. And I think that's super important in the mindset. And that's like a lot that I took from you.
Yeah, I think that's a totally different approach, because in the past, and that is what I meant in the first place by telling, e-com in the past has been not really professional, because people were like you described it with, they're sitting in Dubai and just trying to scale their campaigns. That is not what we are looking for. We are trying to build an organization that is producing money by setting the right processes in the right horizon, that you are selling a machine. It is nothing different to sell a very good e-commerce business compared to selling an iPhone, because the iPhone is able to produce a certain value in your daily life, and the business is able to realize a certain cash flow for the business owner. And there is, of course, a premium the investor is able or is willing to buy or is willing to pay by buying your company, because there is a value within the future cash flows. And I think we have to look in regards of business like it is a machine, and the machine either works or it doesn't. And if it doesn't work, it's not worth anything.
Good point.
So what do investors look for in e-commerce? So as I have already mentioned, I think e-commerce itself is a new asset class. I haven't considered really buying an e-commerce brand in the past, but right now, the more exits I realize in e-com, and currently I'm running 7 different exits. The largest one is 12.5 million, is that it is really, really valuable in regard of market share, because brand owners are able to build up such a tremendous customer base that other bigger companies are desperate for those customers, and they are desperate for those business models because they don't have it. There are large businesses which are able to do a large and very, very solid business, but they are not flexible. And e-commerce is a very flexible kind of business, but that's just as a side-by-side information. So by 2021, 2022, a business just had to have a MVP and partial POC. MVP is the minimal viable product, and a partial proof of concept. That is what the reality in the past was. And I talked about this with Dr. Andre Retterath, who is partner at Early Bird Venture Capital, who is based in Munich. And that is the biggest venture capital fund in Europe. They are managing 1.5 billion currently, only in venture capital money. And he told me it was so crazy from March 2020, yeah, the point where COVID hit, until August 2022, it was like founders literally received blank term sheets for getting investment. And the investors didn't care about really the business. They just tried to allocate their money more or less in a sensible way. And right now there is a consolidation in the market because investors are trying to do more due diligence. They're considering more in detail which companies they are willing to invest in. And that is the reason why, of course, you need a minimal viable product. Of course, you need a proof of concept, but you need a WTP, which is the way to profitability. If you're not profitable and you are running a 8-figure revenue a year, it doesn't worth a dime. And a very famous example for that is Gorillas. Probably you know it. For all the German listeners, there's a really, really great podcast in Germany, which is called Cash Burners, the Gorilla Story. And if you haven't heard that, just go into it, because they burned 980 million euros in funding within 3 years or so. And that is insane. And you have to have a business that really is profitable. In e-commerce, it's a different story, but I'm always telling the same, because some founders think their business consists out of raising money, burning money, raising money and burning money. And that is not business. That is insanity. So what are you looking for? There are basically three different kinds of investors you should be going for. VC is venture capital, which is very, very early stage. GC is growth capital, which is the midterm money when you are getting out of the baby period and you are getting a little more developed. And private equity is all the senior money. When you are developed, I already did a case study with our good friend Sebastian Czerlinski. It's a German case study where we talked about the Quality Group, which is a German nutrition company. And they got funding by CVC, I think, yeah, CVC, which is probably one of the largest private equity firms in the world. And they are doing 100 million annual revenue. And that is also a D2C brand, but they are very, very solid and very, very senior over the years. So look for strong growth and scalability potential that they can build to greater value through financing, strategy, development, and management support. You do not need just an investor to give you money. Money is just a byproduct of the investor. What you are really looking for is network and the ability to really scale your business. If you are a really, really big D2C brand and you are probably trying to realize an IPO, so you are trying to get listed at a stock exchange, you cannot work with your local M&A consultant. I cannot help you to get listed at the New York Stock Exchange. You have to work with a large investment bank. And that is what you have to look for. If you're willing to realize an exit until probably, I don't know, 30 million, I can help you. Everything above, I can't help you because complexity is getting so high and the networks are so different and the investors are in such a different league that you really have to know what you're looking for in an investor. Also in an M&A consultant, please be considerate whom you are working with because not every consultant can offer you everything. Large consulting offices and large consulting boutiques cannot offer a really good service to small business owners, to small D2C brands, because they do not really know what the problems are. Large investors and large consultings, they are able to bring in totally different leagues. So the next thing is you have to have an investor who has a really clear and realistic exit strategy. The traditional investor in private equity, whereby growth capital and venture capital is all a part of private equity. Private equity means just private money, not from a public market. They are looking for a 4x return on investment over 7 to 10 years within the investment itself. So you have to really consider it what your investor is doing. And if you don't get what the real exit strategy from the investor's side is, you shouldn't work with those people because they give you money and probably there are some personal liabilities regarding you as a founder, not the entire capital volume, but probably there are 100, 200, 300,000 you are liable as a private person to just push you as an incentive. And if they do not have an exit strategy, you will never be able to realize their 4x goal at least. So having money, receiving money is not the holy grail. It's just a byproduct of a very clear consideration process of which investor you should be working with. And please look for businesses that can achieve significant growth and value to their leadership and support, which means by the business, I mean investors, so professional investment companies, because they have to help you to grow. You can be the greatest founder, but you cannot know what you do not know. And they have to give you new perspectives and which steps are relevant to get to the next level. It's not only about hiring, it's about setting the next scalable steps or the next step in scaling the entire business. And I think that is also a very big mistake because there are some investors in the range from probably 100,000 to 2 million who are offering you money by just offering you money, and then they are trying to disappear. And 2 or 3 years later, you get a call by their lawyer and they are telling, actually, we want to sell. And they never really helped you. You just burn cash. You have just, if you got 2 million, you have probably 1 million or 500,000 still in the bank, but you have to make a payout depending on the terms you negotiated within the letter of intent and the actual purchase agreement or the investment agreement. And that is a very important point to be considerate when there is money on the table. Money is not the only thing you should be looking for. Money is probably max 25% of the entire investment strategy. So how do I find investors for e-commerce? Are there any questions, Carl? You have a question?
No, that was perfect. Yeah.
Okay, perfect. So how do I find investors? So that is what I've already mentioned by the different periods of investment. Very early is seed, startup, expansion, turnaround, replacement, MBO, LBO. That is just the time frame. And in the beginning, usually there is venture capital. That is the reason, this pushback here, that is the reason why you need venture capital, because you have to overcome a period where you have negative cash flow. And by the period or by the phase of expansion, you are turning the negative cash flow, the negative free cash flow into a positive cash flow. And you are switching over from just, business angels, incubators, crowd investing to bigger VC firms, like I've mentioned, Cherry Ventures, Early Bird, Project A. There are different investment vehicles. And then you are switching into private equity. Unfortunately, there isn't mentioned, but right in between there, between private equity and venture capital, usually there has to be a line where there is growth capital. It's like a mixture out of venture capital and private equity. They are looking for a little less risk and a little less return. The more senior the money gets, the less return is expected from the side of the investors. The earlier the investments are happening, the higher the ROI expectation, because the risk is higher. If you are investing 100,000 in an early stage, or probably as a business angel, very famous example in the earlier days, Peter Thiel, who invested, I guess, $500,000 into Mark Zuckerberg and made $500,000 to 3 billion or so. That is very, very risky, but there is a very high potential return. And the more senior the money gets, they do not expect a 100x or 500x. They are very, very satisfied by 4 to 7x within 15 years. So, and that is a different approach, just to give you a perspective, which capital or which kind of capital is available within the market. So how do I find investors for e-com? First of all, you have to be prepared. Preparation is absolute key. You have to have a very clear and perfectly set of documents where your business is in a very good shape with perfectly updated finances, records, and the business processes. Ideally, you have a kind of online course or business handbook where your business is described. Don't worry, you have NDAs, you have non-disclosure agreements, in German Verschwiegenheitserklärungen, and LOIs, which are in German Absichtserklärungen, the letter of intents. And you have to be prepared, because when the investors are trying to make a due diligence in the first place, which is a very, very short form of DD, it's like if you're applying for a job and your CV is shit or your set of documents is shit, you can be the greatest genius overall, but if you are not getting considered just by the fact that your documents are shitty, you are making yourself irrelevant. So determine value. Have the value of your business determined by a professional appraiser or M&A advisor. So a little marketing from you, because you have to have a neutral instance that is able and willing to give you a clear outlook on what your business is really worth. Because founders, they are biased, they are noised by the emotional story they are telling themselves about their own business. Oh, it's so valuable because we have this, we have that, we have already experienced this. And if you are doing this and that, that could be happening. Be sure, value is only what is, not what could be. Because If value is what could be in the status quo, every business should be a unicorn. But in the daily life of business, there is a tremendous difference in between theory and that what's really happening. So really be clear on what the value of your business is and what you can offer to the investor. So next step. Oh, I missed a gap here. So find buyers. Search for a potential buyer by contact business advisors, investment bankers, depends on how big your business is, of course. If you are trying to sell a 5 million business, you do not need an investment banker. You probably need a very niche down M&A advisor that is focused on your niche or on your kind of business model. I think in e-commerce, there is not a real investment bank or a large consulting company that can really help you. Except the fact if you are running Zalando or I don't know, they are very big D2C companies, but they are not what we are talking about. So please be sure, look for an M&A advisor that has a proof of concept and a track record by advising companies like you are, and who gives you the feeling as he is really understanding what you are doing and especially what you are not doing. Next step, offer and negotiate. Once you have found a potential buyer, start negotiating the purchase price and the terms of the sale. At first, you need an LOI, which is just a rough agreement of, yes, actually, I would be willing to buy your business. If they are committed on signing the LOI, they are signing the NDA. NDA is just out of confidentiality. They are not allowed to talk anything about, and they are not allowed to replicate your business. That is a very important point. Founders are telling me over and over and over, hey, if I'm talking to a potential buyer, can I show them my Shopify account? Can I really explain my business? Because what is going to happen if they are getting out of the deal and they are not buying my business? Are they allowed to just replicate me? No, they are not. And that is also a reason why you need a good M&A advisor, because they have lawyers, they have tax consultants, and they will give you contracts that make the deal just waterproof. So you need a very, very strict set of contracts and documents that save your ass. Because if you have a loose set of documents, a potential buyer will just flip the switch and he or she will not buy the business, but they will definitely replicate the business. And that is probably the last time you talk to them. And the last period within the actual closing is once you have all the details, you're just signing the purchase or the contract. And after that, you are going into the PMI, which is the post-merger integration. Site information, 85% of the deals are failing because of the PMI. The money is getting wired, the business is getting sold, but after the payout and after the signing, nobody really cares about the integration. And that is something you have to take care about, because if you are selling your brand and after the exit, the business is trembling and the business is failing, despite the fact that you get all your money, it is part of your track record. Because nobody wants to buy another business from you. And that should be actually a business model, to build a business, to exit the business, to create multiple liquidity events within your entire career. So you have probably 20, 30, 40, 50 million in the end, and you can work with that money. But you can make one exit and that is okay. But if you made an exit and the business failed entirely after the closing and after the getting money process, in the future, I think it will be really difficult for you to explain why the last buyer was not able to run your business that you sold to them. And that has to be really to be considered, because your track record is worth more than probably 500,000 more in exit money. Be sure about that. And if there is an earn-out, rather go into the earn-out within the first 1, 2, 3 deals, because it's about your reputation. And in the investment horizon or in the world of investing, everything is about your reputation. The greatest founders are those who have great reputation. Why is Elon Musk able to raise, I don't know, 10 billion within 45 minutes through WhatsApp? Because he has the reputation that he is able to turn everything into gold. But if you have the reputation that everything you sell is just shit, nobody is going to buy anything from you, especially not a business. Because buying a business is probably the most complex purchase you can ever make. You can buy different financial products, you can buy watches, cars, houses, lands, islands, whatever. It will be never as complicated as a business because there are so many moving parts within a business. So, how to find investors? Part 2 of 2. Look for competitors. If you have a really, really big competitor within your market, and it's very much likely that you know your biggest competitor, that could be the best buyer for you. There are some founders who are only replicating certain business model to sell it to the bigger competitor. A friend of mine who is only building software companies in Munich to exit it to Google. He's doing 1 to 2 exits a year in a range from 500,000 to 2 million, and he's only exiting to Google because he is defining all the processes down to what Google really wants. And that can be a way to make your first exit much, much easier. So option B is a financial investor. If you are looking for a financial investor, you have to be clear that they are not interested in any involvement into the business itself. They are really trying to allocate money and they want you to run the business, which means they will buy the business, but they will force you to be in the business for another 3 to 5 years. Most founders don't want this because then they have money, but they do not really have an incentive to do a really good job. And then you also have to think about your reputation, because if you're doing a bad job as a CEO who has no shares anymore within the business, you will not sell another business in the same concept later in your career, because as I already mentioned, the investment world is very, very small and people are talking a lot about other people. So the most valuable asset you have as a founder is your reputation. The next part, strategic buyers. That can be a competitor, but that can be a business owner who is probably not as innovative or not as digitized as you are. If you are selling something, some kitchen stuff, and you think about, whom could I sell the business to? It could be a very traditional producer for everything that is necessary within the kitchen, because they do not have a really good online business. They have a really solid traditional business, but they could leverage their existing business by just getting the customers you are offering to them. And the last part, you can also sell to individuals or another store owners. Usually that happens only to small businesses in the range of, I don't know, 10,000 annual revenue until 2 million, probably 1 to 2 million. Everything above the 2 million is probably too large for individuals to buy them because they do not get the financing. They do not have the money. Usually there are exceptions, but I think you should really focus on competitors and strategic buyers. Financial investors are very, very complicated, especially in the process of due diligence, and individuals are usually people you are trying to sell the business because you do not want to have it anymore. That is not a really successful exit in the end. So what types of e-com exits are there for e-com? Yeah, there's one e-com too much within the slide. So what types of e-com exits are there? There is an asset deal. As I've already mentioned, you have to think about which kind of exit you want to do. An asset deal is basically you are trying to sell the company, and the company is owning assets like accounts, like inventory, like processes, like staff who are in contract within the business. So your German GmbH, GmbH, or your UK Limited, or your, I don't know, LLC, please do not try to realize an asset deal with a Dubai free zone company. I only can repeat that. A free zone company is nice, but a free zone company is absolutely unable to sell in the concept of an asset deal. In the concept of a share deal. I'm sorry. All I said is regarding to the share deal. The asset deal actually is just selling the assets that are owned, probably the machines, the processes, the documentations. You are selling every piece of asset that the company owns. And the share deal, you are selling the shares to the company that is actually owning the assets that make the business the business. So please, sorry for the confusion, but the first description was only for the share deal, and the asset deal is pretty simple because you're just trying to sell one asset. The asset actually can be just the Shopify store itself and the media buying accounts from Google and from Meta and from TikTok. And that is a very, very common concept for realizing an asset deal within the e-com space. So management buyout is usually not the case, because if you have a real management team within your e-com business, you are making 50 million plus. And the management buyout is basically the concept where your existing management is trying to take over the company and pull you out as an existing owner. So I think that is not relevant for 99% of the e-com cases. Then you have the leverage buyout, where someone is coming and trying to take over your company by putting a lot of leveraged money, so no equity within the deal. You do not have to care about where the money is from, but it's very unlikely that a leverage buyout is going to happen, because you need a lot of equity, and the leverage that is getting out of those kind of businesses is very, very low. And those two kinds are very, very unlikely. That is impossible. And the spin-off or the carve-out basically means you have a business and you are trying to sell a part of the business. So that can happen. That is a usual case. You have one company and the company is running different shops, and you are trying to extract one of the shops, and you are transferring one of the shops into another legal entity, and you are trying to sell the legal entity as a share deal within the concept of a carve-out. But that is not happening very often. That is one of the solutions we are using for selling a brand which is owned by probably a Dubai-based free zone company. So just for your information, I think the two cases you should really be focused on is the asset deal and the share deal. That is what happens in 95% of the cases for e-commerce business owners who are willing to realize an exit. So now we are getting into the first case, which is Bears with Benefits, and the company is actually called Beauty Bears GmbH. GmbH is just a legal entity in Germany or in Austria or in Switzerland. So Bears with Benefits, has been acquired by Havea Group, and the price is not public. I was not able to research the actual price Havea paid the two founders for Bears with Benefits, but it's a mid-double-digit million euro amount for the company. I checked the balance sheets and I checked the profit loss, and the results were not really impressive. So the premium Havea paid for the entire brand was huge. I don't know what the leverage is, because I didn't know what the actual purchase price was, but there was a significant leverage within it, because there has been a year from 2019 to 2021 that has been a negative profit. And if you are trying to multiply a negative profit, actually you are going to, the results will be negative too, because so it doesn't make any sense. But there's a very large premium Havea was willing to pay for Bears with Benefits. And just for your background, Havea is a French group of companies that sells various cosmetic brands, because Bears with Benefits are actual gummy bears, but with some additives and nutrition additives. So they niched it down to a cosmetic brand to improve your hair quality, your skin, your everything that is regarding to health and cosmetics. And Havea, all in all, the portfolio companies they bought, they are doing 200 million euros in annual revenue. So Bears with Benefits has more than 20 different food supplements, and they are offered a price between 20 to 35 euros. I think the margin on an AOV of 50 euros is probably 42 to 43 euros, customer acquisition included. And I think the unit economics has been the reason why Havea was willing to pay such a high price for the business, because the management skills of the two founders, there were two female founders, were not very, very extensive, but they were good. And so I think Havea implicated a lot of potential for Bears with Benefits for a future outlook. And why could that happen? Why could the exit happen so easily? They has been bootstrapped, and there were no complex capture tables and no liquidation preferences and all that stuff, which basically means the cap table, so the owning structure of the company, was super simple. There were just two founders. They owned the company. They founded the company. They had no external investors. There were, so to say, no external liquidation preference. A liquidation preference is if you are getting an investor on board who is part of the cap table, they are trying to negotiate a liquidation preference. And a liquidation preference basically means if you are going to sell your company, there is a minimum level of cash they are getting, which means if you have a liquidation preference for your agency car, and the liquidation preference has a level of 500,000 euro, and you are going to sell your agency for 500,001 euro, the only money you get is the 1 euro, because the liquidation preference says that your investor is going to be compensated until the level of 500,000, and just the money that is going over the liquidation preference is going to be separated aliquot, so by the part of the share structure itself. So please be careful with liquidation preferences, and that is a very good example why it is helpful to not have an investor in the first place, because exiting is going to be much easier by not having any external investors. So that are the two female founders I've already mentioned. And if you want to read the entire article, the entire presentation, I guess, will be linked in the video description. You just have to scan the code, or you can scan it right now. And I have linked the article to this, or I have linked this article, and you can access that very easily. So that is actually the company registration document. As you can see, there is the Beauty Bears GmbH, and in the first place, they made the minimum pay-in of 25,000 euro, which is the basic capital in Germany, which is called Stammkapital in Germany. And the company has been settled in Grünwald, which is a very, very tax-optimized location in Bavaria. It's just 30 kilometers away from here, and it's a very famous and rich suburb of Munich. And there you pay very low taxes compared to all the different locations around here. And now everything changed. They made a capital raise from 25,000 to 50,000 euros. And there is a new CEO, which is Nicolas Brodecki, I think he is going to be pronounced. And this guy is a representative of Havea. And as we can see in the next document, 100% of Beauty Bears GmbH is right now owned by Havea Germany GmbH. So the original founders right now have 0% ownership within the company. That is one of the exit scenarios a lot of founders are chasing. They are trying to sell 100% of their business. But I have to be honest with you, that is not the usual case, that someone is, or some institution or some other business is coming and they are taking over your business by 100%. They are trying to buy 50% and another 20% and another 10% just to minimize their own risk. And there is a concept of dollar cost averaging, probably you know that, and that is what they are trying to realize, to minimize their own risk. But that is a typical 100% exit within a very short period of time. And if you would use a case study for a perfect exit right now, that is bears with benefits. So do you have a question, Carl?
No, really interesting that it's so doesn't happen often, right? Because like everybody's chasing, but as you said, like everybody has this dream of just like exiting 100%, and you say it's like a really rare case.
Yeah, it's really, really rare. So there is another case, sushi bikes. I think that is a very, very prominent case because one of the most famous comedians in Germany, who is called Joko Winterscheid, or also called Joko, is part of the cap table and supported the founder. And we will get, that is just a description of what they are doing. Basically, they are a manufacturer for really high quality, innovative bikes. And they have a pretty high ticket. I think they are starting at 2,000 euros a bike. And in my opinion, they are just focused on city bikes. They call them different, and there are some a little more off-road orientated bikes, but basically no dirt bikes and no free ride bikes or stuff like that. But what I'm really interested in is actually the capital structure, because first of all, the company has not been called Sushi Bikes. The first name was AW Mobility GmbH. Why AW? Because the original founder is Andy Weinzierl, which are his initials. AW is Andy Weinzierl, and I know himself personally because he's going to be on my podcast within the next few days, and I talked about this with him. And by the time, some stuff changed. You see, there is a little capital raise from 20,000 or 25,000 euros to 26,316 euros. And the name of the company has changed from AW Mobility GmbH to Sushi Mobility GmbH. Why they called it Sushi, I haven't researched that. I think there will be an elaborate story for media, but I don't know what the story actually is. And there is a really interesting part about the cap table, because first of all, everything was owned by Andy himself. And right now there is an AW project UG. A UG is more or less a minimized version of a GmbH. A GmbH is defined by having a absolute necessary capital of 25,000 euros, and you have a legal framework that isolates your business from your personal liability. And the UG does basically exactly the same, but you do not have the 25,000 euros, which is a founding privilege, if you want so, because you do not have such a high level of capital that you have to bring on the business. But that is just the holding company. He called it Project UG, but actually it's just a holding UG. And then I was really, really interesting about all the other companies who are on the cap table, because as we can see, there 57% of the business is still owned by Andy. Not directly, but indirectly through his holding structure. And there are some different people who I didn't even heard of, in the first place at least. And there is 8 Ventures Berlin GmbH. And I thought, that could be Joko, but let's research this. And there is Kreis Capital and Max Wittrock GmbH. I have heard Max Wittrock in the first place, but I actually didn't know who that is. And there is a J Collect GmbH, and there is just such a low capitalization, or just such a low share for all those shareholders. And Andy still owns so much of the business. So, but nevertheless, I invested some money and bought all the documents to research who all those guys are. That is Max Wittrock, Philipp Kreis, Oliver Frank, that is Andy actually, who I've mentioned, the founder of Sushi, and there is J Collect Capital. And I was really interested because who the hell is J Collect Capital? And then I was researching. That is J Collect, and there is a DJE Capital AG. AG is the typical stock exchange listed company usually. And there is a J in Jasmine and a J in Jan. And both of those guys are directors of the J Collect GmbH. And I was thinking, who is connected, who is really personally connected to this group? Jasmine would be the only female. I think that is not very much likely, but that is not a proof. And then I researched, there is Dr. Jan Erhardt. And Dr. Jan Erhardt is this guy who is also the managing director and CEO, or the vice president of DJE Capital AG, which is a very traditional capital management company. And as you can see, they have private clients. That's just a screenshot from their homepage. And they have institutional asset management and all those stuff. So they are professional investors. And I think why they got into the cap table, as we see by a level of 5% of the entire capital, is because they can offer all the other guys access to more capital. And then I was thinking, how is this business really working? Andy is a smart founder, but there is another person who is 8 Ventures. And 8 Ventures is not directly represented by Joko Winterscheid, but there is another managing director who is representing Joko Winterscheid on this company. I haven't bought the owner structure from the German Handelsregister to see who is owning 8 Ventures, but it is very, very likely that that is Joko Winterscheid. So as we can see, Joko is owning currently 19% of Sushi Bikes. And Sushi Bikes is a very, very good example for a traditional venture capital case, because in the first place, as we can see, Andy started with just his little money. He called it with his initials, and then the venture capitals or the business angels basically came and supported him with money. Of course, I think there is also some money included, but especially, and that is the big asset he got, the media exposure by Joko. Joko, I don't know, is, I think, the most famous comedian in Germany, and he has so many different ventures he's invested in. And Joko promoted the bikes like crazy, and they increased their revenue, I guess, 100x in 12 months. And they really had manufacturing problems, and that can be also a kind of exit. If you have a D2C brand and you are trying to realize an exit, you can use one of your brand representatives and use them by giving them equity and increasing the entire company value and selling it afterwards, because having such a prominent face on board or on the cap table will increase the value of your brand tremendously. Just for your information, if you are working with influencers and very, very famous influencers, try to bring them on the cap table with not such a, there is no necessity for a high level of capital ownership by those influencers. But it is a good idea because they have an intrinsic motivation to push the business and push the brand value. So, and the last case is actually Snox, which I think is the most interesting case, because they founded, there are 2 founders. If you don't know, Snox are selling underwear, and they started with socks. So just strike out the N, and so you have socks. And they were trying to make better socks. They are not cheap, but they're really high quality, and they have a lot of guarantee, like a no hole guarantee on all that stuff. And they did a really smart way of marketing. And in the first place, as we can see, they started as a Snox UG. A UG, as we've already mentioned, is basically just a GmbH with less capital. They started with 4,000 euros. And there are 2 founders, like there is Johannes Kliesch and actually Felix Bauer, who is not mentioned in here. Here is Felix Bauer, who came on board just later. Johannes founded the company on the 4th of July 2016 or 18? 16, and Felix came on board on the 3rd of January 2019, so 3 years later. And there has been a lot of change within time because they sold a part of the company, and we will get into the ownership structure later, to a private equity investor, and not just a small private equity investor, but they sold it to Carthai Capital. Carthai Capital is a French-Chinese private equity firm, and I think they took a lot out of the business. But it is funny because they still have the majority of the shares in their ownership. And there is a company which is called Snoxperium GmbH. And if you are non-German, it's a combination out of Snox, Imperium from the Imperium, which is in English the empire. So you have just the Snoxperium, which is the holding structure, the mid-level holding structure for Felix and Johannes, and they are still owning 74.8% of Snox, which is a multi-million D2C brand. And there are two, or basically just one shareholder, which is Gur Capital 1453 GmbH. And by this name, you know the investor is not a hobby investor. If they are calling their companies with those numbers, you know they have a lot of companies, and we'll get into the structure of Skjor or Carthai on the next slide. So give me a second. Yes, that is Johannes. And that is Felix. Johannes has a holding company, which is Kleptil. I think they like puns and word games, so they are mixing all the words together. So that is Kleptil GmbH, and Felix has Felix Capital UG. And that is their personal holding company, which I guess they own each of them by 100%. And I think there is a structure where those holding companies own 50% of the mid-holding company, which is still holding 74.8% of the actual business that is realizing the operative part of the business. So, and now we are getting into the Snoxperium, as we have already seen. There is Alpha Capital. And now I was interested, I wanted to get into it with Carthai Capital, how the structure of Carthai really looks. That is Skjor Capital 1453 GmbH, which owns 25.2% of Snox GmbH. And the CEO is Jan Dietmar Karas. And as you can see, Jan Dietmar Karas is CEO or managing director by a lot of companies. That is a really extensive structure of legal entities. And Carthai Capital, they have 3.8 billion or 3,800 million euros under management, which is not huge, but it's still a large private equity firm. They have more than 220 investments, 19 funds, and more than 130 professionals. And I have made an extensive research on how the due diligence worked with Snox, and it cost 500,000 euros to only realize the due diligence for Carthai Capital to decide either they are willing to invest in Snox or they are not. So by just getting back, I do not want to get too deep into the numbers, but I offered you all the financial details the company published for 2020 and 2021, so you can just get into it. But as you can see on the charts, they had a really strong growth structure and growth story. That are all the financials in detail. And Johannes, one of the founders, was recently on a podcast, a very famous German podcast, and he admitted that the exit he made was actually a secondary. A secondary is just a terminology for the founder is selling part of his shares to a professional investors and is taking money out of the deal because he had very bad experience in his private life. And he said, hey, I wanted to settle myself a little more financially. And he took out a few million out of the business. And the funny shit is that he only sold 25.2% of stocks. And he and Felix, each of them got a multi-million exit volume. I think they got all in all 10 million. So everybody of them got 5 million in cash, which is not too little based on the fact that they are still owning 3/4 of the entire business. But there is a very important part in Germany why Kothai, indirectly through Skure Alpha 1453 GmbH, wanted to have 25.2% of Snox GmbH. I explained it in here because if you have more than 24.9 or at least 25.0% of a business, you have a so-called blocking minority. And a blocking minority actually allows you to block decisions despite the fact that you are not the major owner of the business. That is also very important for you. If you are trying to realize probably a secondary, or you are trying to make an investment into another brand, which is also possible, also for Eurocar, and you are trying to get some equity of a brand, try to get more than 25.0%, because otherwise you will not have a chance to hit any decision. That is very important. And last but not least, I have some best practices for you. And the first of all is you have to be really, really clear about your documents, because you have a very clear set of LOIs, and it must be, I cannot describe it as important as it actually is, because every word within the LOI has a meaning, and within the LOI, there have to be parts which are legally binding and parts which are legally not binding. And you have to have a lawyer that already has done multiple deals and has experience in M&A to offer you an LOI that is actually covering your personal interests and the necessity to just save your ass. And that is also a very smooth switch to point B, because please never ever work with the lawyer you use for your traffic stuff and your, I don't know, family stuff. You have to have a lawyer and a tax consultant and probably an accountant who is really only focused on M&A, because that is like having, I don't know, a trainer and you are trying to prepare for Olympia. It is a total different game with a total different set of rules. And if you have a lawyer who doesn't have real experience, and you have a tax advisor or tax consultant who doesn't have real experience in M&A, they cannot even tell you what you have to do because they haven't done it themselves. And it's just a totally different world to realize an M&A deal compared to your usual accounting and probably a purchase agreement or some stuff you are usually doing with your lawyer. And last but not least, you have to focus on your NDAs, especially in the process of allowing others to do a due diligence on your business, because they are getting information out of your business. And as I have already mentioned within the presentation itself, there is a tremendous risk that other investors are trying to just get information by signing NDAs that are not really bulletproof. And after the due diligence, covering your business one-on-one, because they know every supplier, they know every software you use, they know all your campaign strategies, and you have no guarantee that they haven't done a copy or some kind of replication of the documents you provided. That is very, very important to work closely with lawyers who are really, really focused on covering your intellectual property. And that is very important, especially in e-commerce, because a lot of the intrinsic value of your company is intellectual property. And IP law is probably the most complex law you can get because it's not really tangible. You can touch an iPhone and you can describe an iPhone, but it's very difficult to protect your idea or protect the processes you have set up to create such a good business. And in the end, there is just one thing I really want to tell you. Exits are absolutely great, but it is much better if you have the choice to do an exit and you are not forced to, as a consequence of a bad moda operandi, which means you're not able to make a great business and you're just trying to sell shit. Please do not do this. Try to create a machine that has intrinsic value, that is able to produce free cash flow, and the free cash flow at the moment has a tremendous value for some investors in the future, and that should be an option for you. It's like within the traditional financial market, you are giving yourself an option to get cash right now, which makes you, of course, able to do more investments and create just a better business situation for yourself. And in the end, I just can say thank you to Carl and to you to be interested in the topic. And all the documents I have offered will be offered by Carl within the video description. You can just download them. I will give them for free to you because I already bought them for you. So thank you for your attention. And if they got any questions, I'm ready to answer.
Bro, I'm stunned. This was crazy value. And it's also really interesting for me to just listen. I was like so quiet because I was just like absorbing all of the information. And for me, especially the case studies were super interesting just to kind of understand that there are different ways of getting an exit deal done. And it's not always about just 100% exiting the business. And I also found, for example, the case study from Snox super interesting. Like on the way, right? I think they did like 50 million last year total with like Amazon and the D2C store. And they want to build it to like a 9-figure brand on the way, just like giving some of the equity away to get the liquidity privately. On that, really interesting. So thank you so much for sharing. And yeah, see you soon.
Yeah, some additional information to the case of Snox, because it's not only to get liquidity for yourself, but what you get is a very professionalized structure of investors and managers who can help you to bring your business to a new level. Because I think you know it perfectly. It's not the same way of doing business if you do a 6-figure, a 7-figure, and a 8-figure business. And it's totally fucking different to do a 9-figure business. And you need management skills normally you cannot have because you do not have the experience. And by getting some investors on board and selling your business part by part, you give yourself the chance to build up a management skill set that you cannot give yourself. I think it's like a paid learning. You get money to learn. You get money to learn something from people who have done much greater deals and much more complex deals than you have ever done in the past.
Yeah, super sick, bro. Thank you so much for jumping on.
Thank you so much, and all the best for your visitors and for your customers.
Thanks so much.